All right, everybody, this is the Greater Estimator, and welcome back to another episode of Auto Body 101. And this is the channel where we look at before and after pictures of damaged cars, and we talk about everything that is involved in returning that vehicle to pre-loss condition, meaning completing the repair. All right, but today we're going to actually talk about something that a lot of people don't understand. People who are not in the insurance industry do not understand. This is something that your insurance company does not tell you when you first get your policy. This is something that they'll never tell you. They don't explain this to you. And this is considered one of the biggest lies in the industry, or maybe not a lie, but maybe a half truth. Okay. And it's this: people out there believe that it is the insurance company's job to fix their car no matter what. And that is simply not true. All right. That is the biggest lie in the industry. Okay. In fact, it is the insurance company's job or obligation to fix your car only when it is financially feasible for the insurance company to do so. In other words, when it makes sense, and I mean dollars and cents, when it makes sense financially for the insurance company to fix your car, it will. When it no longer makes sense for them to fix your car, they will not fix it. Now, I can't tell you how many times I've had to go see a car, and then I've had to call up the owner of the vehicle and let him know, hey, Mr. Smith, I'm sorry, but after inspecting your vehicle, I'm afraid I'm going to have to declare it a total loss. They say, total loss? What do you mean? You're not going to fix my car? No, Mr. Smith, I'm not going to fix it. What do you mean you're not going to fix it? It's your job to fix my car. Or what am I going to do? I need my car to get to work. I'm not going to have a car. What am I supposed to do? And I have to explain to them, well, Mr. Smith, yes, you're right. It is the insurance company's job to fix your car, but only when it is financially feasible to do so. Now, let's go into when a vehicle is financially feasible, when it's not financially feasible for the insurance company to fix the car. People don't know this, but whenever your insurance adjuster is writing up your car, there is a certain point where it no longer makes sense to fix it. And this is determined by the cost of the repair estimate. Now, let's say for all intents and purposes that you're fixing your car, and the estimating software that they use, once you put the VIN number in and the mileage and all that stuff, it uses the year of the car, it uses the mileage on the car and all of the options and everything, along with the repair estimate to determine what the total loss threshold is. And it's 75%, but when I say what the total loss threshold is, it determines when you've met that 75% threshold. Now, is there some wiggle room there? Yes and no. And this is depending on the shop you're working with and the supervisor that you have, to be quite honest. Now, there have been times when I've been writing up a car and I'll meet the total loss threshold, and the shop will ask me, hey, what's that car worth? And I'll tell them, for argument's sake, hey man, it's worth 10 grand. What are you at? I'm at 7,500. All right, you know what? Give me $6,800. I'll never call you back. I will not call you on a supplement. Now, fortunately for me, I've never been bitten in the ass where I've agreed to fix a car and, giving them the money and that's it. You can't call me. I've never gotten a call back from a shop to come down on a supplement when I've made that type of deal. Now, does it happen? Yes, it does happen. Fortunately, it's never happened to me. Now, we're going to get into some reasons why the insurance company wants to total out your car. All right. And there are a few reasons. The number one reason is the insurance company only wants to fix a car one time. After they fix the car, they want to be done with it. Now, in the case of vehicles where there's very complicated wiring and, there are all kind of electronics in the car, and if the vehicle is hit in an area where there's a lot of open items, the insurance company is going to say, you know what, we're not going to fix this car. Your supervisor will make an arbitrary decision. Hey, total it out. We don't want to have to worry about this thing. The last thing the insurance company wants to do is fix your car today and then have you come back 6 months later and say, hey, listen, I'm hearing this rattling sound. It's on the same side where the car was hit. I think there's still something going on with the car. If they can prove that whatever is still going on with the car is related to the collision or the loss, then guess what? The insurance company's on the hook for it. And the last thing they want to do is have to total out a car after they've already paid to fix it. They don't want to have to have paid $20,000 and now they have to pay $40,000 for the value of the car because it's now a total loss, because the damage that you didn't verify or could not see or just missed for some reason is now worth so much to fix that the vehicle is no longer worth fixing financially for the insurance company. Okay, so that's the first reason. The insurance company doesn't want to have to fix a car more than once. The second reason is something called salvage. Now, the insurance company, once it's been determined that they are that the policyholder is at fault and they're on the hook to fix the car, the insurance company now has the right to salvage in a total loss situation. Now, what is salvage? Well, salvage is a guaranteed bid offered by an auction house for your car. Now, when I was writing, I believe the guaranteed bid was at least $300. I don't know if it's gone up or down since then. I'm really not sure. However, when I was writing, it was $300. That was the guaranteed lowest amount that the insurance company could get for any car once it's been declared a total loss. Now, when you're dealing with higher end vehicles, the salvage amount goes up. That bid goes up. So if you have a 2005 Toyota Corolla, it's going to be $300. All right. But if you have a 2021 or a same model year BMW or Benz, and the value of that car when you run the evaluation is say $80,000, you're going to get a really high salvage bid. The insurance company knows this. So they're going to want to total out your vehicle. They'll pay whatever the vehicle's worth as far as the actual cash value. I don't want to get into ACV and fair value and all that stuff, but let's just say that the vehicle is worth 80 grand. They're going to get a bid for maybe 35,000. That's a lot of money for the insurance company. Okay, so they're going to pay it out. They'll pay out whatever the fair value, the actual cash value is, minus any deductions for wear and tear and things like that. And, they'll take the car. The insurance company has the right to take the car when you're a policyholder. Okay. When you are not a policyholder, when you are a third party as opposed to a first party, and it's when I say first party, I mean the policyholder. All right. When I say third party, I mean the vehicle that was hit by the policyholder. And the first party and third party can have the same insurance company. It's just different because one is hit and one is doing the hitting. Okay, so when I say first party versus third party, all I mean is the first party is the policyholder, the third party is the vehicle that the policyholder is hit. Okay, so even in third party claims or when the insurance companies are different, the policyholder's insurance company still has the right to salvage because they're the ones paying for the hit or paying for the total loss. So they might not have the right to take the vehicle in a third party situation, but they still always have the right to salvage. They have the right to that salvage bid. So even if they don't take the car and bring it to auction, and mind you, the guaranteed bid, that's the lowest amount that the auction house is offering. So it could be even higher once it goes to auction, but we're not going to get into that just yet. But as far as the third party goes, even if the insurance company does not take your vehicle and, the third party wishes to keep it and fix it themselves, the insurance company is going to deduct whatever the salvage bid is on that car from the payout. So if it's 50 grand and the salvage is 20 grand, they're going to pay out $30,000. 50,000 minus 20,000 is $30,000. That's what they're going to pay out to the third party. And they're just done with it. If they take the vehicle to auction, who knows? Instead of that 20,000, they may get 25. They may get 30, depending on how hot the vehicle is, depending on how difficult it is to get parts for that type of vehicle. Because yes, shops out there will buy salvage cars just for the parts. They're not buying them to fix them. They're buying them just for the parts because there might be a shortage of parts for a particular car. If they can get a particular car at auction, they'll get it and they'll just keep the parts. So when that type of car comes in, or if the insurance company calls up a salvage yard, a junkyard, they have those parts ready to sell to the shop. All right. So yeah, salvage is huge. Salvage is huge, and a lot of people don't understand salvage, but the insurance company, as long as they're on the hook to pay, they have the right to take your vehicle if you're a policyholder, or to take just a salvage if you're a third party. All right. Now, another reason, and listen, the threshold is 75%, but really and truly, it's whatever the insurance company says it is. All right. It's all about the open items on the vehicle, all the things that could possibly be wrong with the car. So instead of reaching that 75% total loss threshold, they can total out a car at 50%. And there are different ways that they do this. It's possible. I don't want to get into all the different ways, but it is possible to do this without hitting the 75% total loss threshold. All right. And I myself have done this, because if you're looking at an expensive BMW or an expensive Mercedes-Benz or something like that, it could be a Jaguar, it could be a Bentley, it doesn't matter. When you're looking at the open items on the vehicle, all the things that could be wrong with the car versus where you are already writing up the estimate, you're going to be like, man, I'm at, I don't know, $25,000 on the estimate. The open items are like 15, 20 grand. I'm not going to keep writing this car. I'm going to total it out. It does not make sense for me to keep writing this estimate. It does not make sense for me to fix this car, because potentially there could be all these other things wrong with it. So I'm just going to total it out. There are different ways that the insurance company does this, and I myself has done this. So yeah, man, do not believe for a second that it is the insurance company's job to always fix the car. It just doesn't work that way. It happens that most of the cars that are in a loss are fixed, because in my experience, most of the cars that I wrote, the insurance estimate was anywhere between $1,500 and $2,000 or $2,500. That's not a lot of money. So a lot of cars, yeah, the majority of the cars I did fix, but there were some that I had to total out, and this was for different reasons. But yeah, man, and this is not against the law. It is not against the law. It's all about dollars and cents. It's completely legal, and it's all about the money. It's all about the money. The insurance company is a business, just like any business. Its job is to make money for shareholders. Its job is not to lose money. And by fixing a car that you really shouldn't fix, because there is the possibility that the vehicle could be declared a total loss later on, that's not good business. So it will not make sense for the insurance company to fix that car. They'd rather just total it out. All right. So yes, that is the biggest lie in the insurance industry. The biggest lie in the business, or it's just a misunderstanding on the part of people who are not in the business, who don't understand the insurance law, who do not understand car repair. They don't understand how the insurance company works. They think that it is the insurance company's job to, no matter what, fix their car, and that simply is not the case. There are situations where they are legally obligated to write the car off for whatever reason. All right. But yeah, that's what I wanted to get into today. It's a little different than what I'd usually be doing, but I just wanted to explain the reasons why the insurance company may not always fix a vehicle. Okay. But yeah, this has been the Greater Estimator. Thank you for tuning in to another episode of Auto Body 101. And yeah, if you want to stay up to date on all my latest videos, please make sure to like and subscribe to the channel. All right. It's the Greater Estimator. It's been fun, and I'll catch you on the next hit.